So let's come to the Ask Weekend Investing round. Here, what we do is we collect queries from users, followers on Twitter. Anybody would like to ask us anything, and we try to answer them to the best of our abilities. We've done many such rounds before, 44 rounds. All those videos are available. 740 queries have been responded to till date, and more to go today. So today's first query is from Nimesh. He says, why should any long-term investor consider something like buying puts or fancy derivatives for hedge when gold in Indian rupees has returned 13 plus CAGR? It's a very valid concern and question. In my view, you don't need anything fancy. If you club uh, gold holdings along with your equity in India, you should be on a fine, complete portfolio. You don't need anything else beyond that, according to me. So the fact remains that simple things are not appreciated neither in life nor in markets, and hence, if you tell somebody that you just buy gold and that should take care of most of your, hedge related issues, nobody's willing to believe that. And the testimony is the returns that you've already mentioned, and there been a long history of several decades of that correlation or inverse correlation being there, and hence no reason to doubt that versus any other fancy derivatives plan that one may have. Shravan has the next one. I understand momentum may not outperform on the downside during every correction. In which of the following scenarios do you loosely expect momentum to outperform the benchmark? So whenever we will find, and he's given a couple of options here, GFC 2018-20, short corrections like the current ones. So typically what will happen is that when the correction is very deep and a lot of bloodletting is happening, for instance the GFC, you will find that strategies that have to go to cash at some point will go to cash, and the market may continue to drop beyond that. 2008 was certainly a market like that. At other times, if there is very stock specific correction happening, let's say in IT stocks in the dot com correction, then stocks would have rotated to other sectors like healthcare, FMCG, etc., in rotational strategies which don't go to cash. And there again, you would have benefited out of not having exposure to the sector that is getting hit at that point. So it can outperform the benchmark on the downside also at times. In shallow, shorter corrections like we have been seeing last many months, it has not been working to the effect of outperformance. But yes, it'll break the journey of the downside also as much as possible. So that's sort of the expectation out of momentum. And of course, on the upside, one is expecting to beat handsomely overall, uh, the strategy to beat the index and on an upside as well as downside basis combined. Harinder, as the next one, I've been asked to not invest in a particular stock by my employer for a period of 6 months. I really wish to invest in your strategy, how to ensure that I negotiate this problem. So it's easy to do this. Let's say you are in a strategy which requires you to hold 20 stocks, and one of those stocks is something that is in your blackout list. So you can go to the customize option in the rebalance. And when I'm asking you to add that particular stock X, which you don't want to buy, you can customize your buys and remove that stock from your list. So your portfolio will only buy the other rebalance stocks, and you could replace it with perhaps liquid base, or you could allocate that capital to the rest of the stocks if you like. So both options are available, and the only thing is that when you start the portfolio the first time, at that point of time you will need to buy that entire first lot, and then perhaps maybe you can, within a span of a short while, you can get out of that blocked stock in case you are already knowing that stock when you start the portfolio. But when if a new stock comes into your portfolio during a rebalance, you can certainly customize it out, and that's how one could uh, bypass this problem. Ashish Patra has the next one. What are the tax consequences of investing in any of your strategies? I am a US based NRI. When we invest in mutual funds, we don't pay any tax. We don't pay tax for any selling happening by mutual fund due to their internal rebalancing portfolio. So that part is okay even for Indian domestic investors. So there's no specific NRI issue there. However, in investing of stocks, we will owe tax from monthly or weekly rebalances when we sell some stocks. So this has nothing to do with NRIs or residents. You basically, if you are either using direct investing, small cases, portfolio management, AIF, in all these cases, the tax burden on every transaction is based on you. Mutual funds are given a special category status where The rotation of the portfolio is not brought into the books of the investor, and the books of the investor only get the buying and selling of the units as and when they do. So that's the sort of differentiation between the two parts. uh, Second question from Ashish is that, can you give an estimate of yearly tax a person will owe from the rebalancing of portfolio choosing any of your strategies that give an annual CAGR of 25%? So let's say you get an annual CAGR of 25%, and for the sake of simplicity, let's say all strategies, all transactions result in a short term capital gain, although they won't. But let's assume worst case scenario that everything is at 20% short term capital gain. So practically at 25% gross CAGR, you will be hit with a 5% short term capital gains, and you'll be left with a 20% net CAGR, net of taxes. The same if it were, let's say, only long term transactions, and let's say you have to pay 12.5% on 25%. So there also you will end up paying approximately 3 point some percent in long term capital gains, and your effective tax rate would be 21.7 or 21.8. So that's the difference between the two. If you assume complete zero short term capital gain versus assuming all short term capital gains, it will make a difference of about 1.8% or so on a 25% CAGR. I hope you got the answer. Jignesh says, I have MI20. Can you please elaborate more on the half yearly shuffle? So the half yearly shuffle is basis the index reshuffle. So the index on which MI20 is based is small and mid cap 400 index, and that gets rebalanced by the exchange every end of 6 months. So March end, you will have some stocks that will go out and new stocks coming in into the index, and the same happens at September end from 30th September onwards. So is it certain that if we are forced to let go of high momentum stocks because of the index shuffle, are we sure of immediately onboarding current winners from microcap, or does the strategy put in a waiting period to observe if momentum is firm? I'm getting your point. What you're saying is that the new stocks that come into the index at the reshuffle, will we wait or will we allow a immediate introduction of them into the portfolio? We will allow an immediate introduction into the portfolio because it is already their good performance that has brought them up into this index from the microcap index, let's say, and hence there is no issue of performance not being there, or waiting to see whether the performance will be there or not, or to wait and see the whether these stocks are worth it or not. So that waiting is not required because the stocks have proven themselves and have come to this index, and hence we will take positions in them as soon as those are changed. Mr. Jagdish Kumar Dikonda has in the next one. How much trading is important in today's market scenario to keep it as a hedge for long-term strategies? I'm not sure if trading is a hedge for long-term strategies. 98% people lose money in trading. So, a hedge is one where if your long-term strategies are not working, then trading is working. So first of all, you need to ensure that your trading is working. So yes, if you are sure that you are going to be making money in your trading, and then perhaps you will need to see whether that is the right hedge towards your portfolio, or maybe buying some ports, or maybe buying gold, or maybe buying some uncorrelated asset can also provide you with some hedge. And hedging is necessary for practically all kinds of investors, even with strong risk appetite, because risk appetite, um, you know if you have seen, let's say, a drawdown of 50%, and you think that 50% is something that I can sustain, maybe the next time you may get hit with a 70% drawdown, and at that point of time you may not have that kind of a uh, you know gut feel to continue. So times can get very, very rough when we look at risk appetite and all these factors. In good times, we tend to make ourselves believe that yes, yes, we can handle it, but can we handle it when the time comes is the question. And it will also depend upon what is your exposure to the market. Let's say if you have 100 rupees and you've put in 10 rupees into the market, and 90% of your money is sitting in the bank, then anyways you don't care whether that 10 goes to 5 or 3 or 2 or whatever. So it will also depend upon your allocations. As more and more allocation will be there, the more and more emotional involvement will be able to get. But yes, I mean, if you are will absolute sort of a a person with a gut of stone, perhaps nothing is required and you can stay invested. Deepak says, if someone is wanting to develop a momentum strategy, what other than rate of change needs to be looked at to identify momentum in a stock? So again, depends upon the design of the strategy. Like it's like saying that I want to do fundamental investing. Besides price earnings, what should I look at? So there can be so many things. You could look at volumes. You could look at uh, multiple periods of momentum, look back periods. You could look at maybe some indicators that some may want to add to their price behavior. Maybe you want to have a filter where your entire subset first gets filtered basis uh, some parameters, which, let's say, a Mark Minervini also, let's say, does momentum investing, but he involves certain fundamental uh, filters to be satisfied before he will look at the price trends of that stock. So again, it will depend upon how you want to build that system. But yes, I mean, if you really wanted to keep it very simple, then a 1 year look back period on ROC is also working. It does not need to get complicated. Again, depends how you want to build that. Manju says some days both FII and DIs will be buy side, but market trends to be flattish with negative bias. Is this the retail impact? Your thoughts? It's very difficult to say on a day-to-day basis what has been the impact of the move of FIIs or DIs, because you see these are also not two entities which play in a conformist fashion. There are few thousand FIIs, there are few hundreds of DIs, and somebody's buying, somebody's selling. What we see is the net effect of that. So when we say net FIIs have bought 300 crores, perhaps the net buying in some small stock was 500 crores, but net selling in large caps was 200 crores. And that's what has impacted the index the other way, while the figures are on the upside. Or they bought some promoter stock wherein it really hasn't impacted the market as such. It has been a direct deal between an FII and a promoter. So very many things, a lot of variables are there. But yes, on a continuous basis, if you will find whether FIIs and DIIs to be on one side and the market not reacting on the other side, that would certainly mean that the general participation in the market is the counterbalance to the FIIs and DIIs. So that's the end of our weekend investing, Ask Weekend Investing round. Do, of course, subscribe to this channel. This is a reminder. We will not be charging for this channel forever. So do like and share these videos and do subscribe to the channel. Use Ask Weekend Investing in the comment section and ask these queries. In case we've missed it this week, we'll certainly take it up in the next episode. All the previous episodes are here in case you wish to go through them and refresh, the 700 odd questions that we've answered rightly or wrongly. And that's a great knowledge building tool for especially for new beginners in the market. Thank you so much for watching, and I'll see you in the next one. Have a great weekend. Thanks. Bye.